In today's video, I will teach you how to get a perfect credit score for free. Now, I want you to know that what I'm going to show you today isn't theory. This is my current credit score, and it's 848 out of a possible 850. But not long ago, my credit score was 781, and you can see here that that was on June 21st. But you can also see that by June 24th, it was up to 830. Now, this change wasn't a random update. I contacted the credit reporting agencies on the 21st and made that change happen myself, and I didn't spend a dime. So the first thing we're going to do for you is exactly what we did for me, and that's find out where we are now. Now you can do that by getting your credit score for free with a link that I've pinned in the comments of this video. Now, with your credit score hopefully in hand, let's go through the numbers. If your credit score is in the 300 to 579 range, this unfortunately is considered bad credit. But don't worry, because we can fix it. If you're in the 580 to 669 range, you're considered fair credit, but I'll show you how to get it significantly higher. If you're in the 670 to 799 range, this is considered good to very good credit, and the tips in this video will easily push you into the 800s. Between 800 and 850, you're at the top of the credit score world, and this video will show you how to make sure you stay there. But you must know that in the eyes of a lender, these ranges are sometimes simplified down to just three categories. You may hear the terms subprime, which is roughly 300 to 619, prime, which is the 660 to 719 range, or super prime, which starts at 720 to 800, depending on where you're looking. Next, we're going to put some hard money numbers to why credit score matters so much. Here you can see the cost of a 620 credit score versus the cost of an 840 credit score over the life of a mid-range home mortgage. With a 620, total interest cost was $549,000. But with an 840, the total interest was $462,000. About $100,000 difference. Either is still a lot of money. But when you have only that last $100K to go, you will really wish that you had started with that super prime credit and didn't have to make another $100,000 in interest payments. But it's more than just 6 figures worth of saved money that a great credit score gets you. People will treat you differently. If you have subprime credit, you'll feel a seller judging you and treating you as a less valuable human the moment they pull your credit. In fact, most lenders will shun subprime credit score people altogether. They just won't want to do business with you. And imagine if you're applying for a new job. That company can't see your credit score directly, but with your permission, they can see the report, and they'll know. And even in your personal life, whether you're male or female, no one wants to get romantically involved with someone whose credit score is 415. I have an acquaintance who's actually been asked what his credit score was before someone agreed to go on a date with him. Of course, you don't have to answer, but if you're above 800, the confidence that comes with being so solid financially is going to shine through in many other areas of life. I want you to have that kind of confidence. Next, let's cover how likely you are to be approved statistically based on your credit score. We'll use credit card applications as our example, and this data comes from the Consumer Financial Protection Bureau. Now, between 300 and 579, only 19% of applicants are approved for a credit card. In the prime ranges, approval becomes common, but you'll be treated as an average customer and offered average interest rates. But if you're super prime, credit card approval rates jump to 84%. And if you're super prime, meaning over 800, you will almost certainly have a higher credit score than the salesperson you're talking to. If you're in an apartment leasing office, this is where you'll see office staff start whispering to their managers. They'll be sliding the candy jar in front of you and offering you cups of coffee. And this is where the Lexus dealer will be asking you to take 2 of their cars home, not just 1. But a related word of warning. This also means you'll be approved for loans that you shouldn't even take. So at this level, you have to self-regulate. As we just covered, credit score is a sort of unofficial social status, and it raises or lowers our future interest costs. But what is its actual official intent? Well, officially, the purpose of a credit score is to predict the future about whether you will or won't repay a loan. Now, this is important for you to commit to memory because each of the 5 components that make up a credit score are created with that specific goal in mind. Let's go through these 5 components of the credit score. The first component of credit score is payment history, and this makes up 35% of the total weighting. Amount owed, or credit utilization, is weighted at 30%. And length of credit history is next up at 15%. What's called the credit mix is weighted at 10%. And new credit inquiries are also weighted at 10% and finish out the calculation. Now, let's go through some tips on how to improve each one of these components. Now, before we dive in, I want to cover something that doesn't affect the credit scoring algorithm, and those are thumbs ups for YouTube videos. They do, however, massively affect the YouTube algorithm, so if you're here, thank you for being here. I'd really like to see your credit score improve, and I'd love to have your support with a thumbs up as well. So as we just said, payment history is the biggest contributor to your credit score. In fact, the dispute that I made was related to payment history. Now, payment history is actually quite simple. Payment history means making the payments you've agreed to make on time. Perfectly on time is what's necessary to build a higher score. And then there are kinds of levels of damage after that. The damage levels are oriented around how late the payment is. 30 days late, 60 days late, 90 days late, and then that final category of late enough to be reported to a collections agency is how they break down. Here, the way to improve is equally simple, and that means building a long history of making every payment on time. For credit scoring purposes, payment history includes activities from accounts like mortgage loans, auto loans, credit cards, and so on. But payment history will also be affected by activity within delinquent accounts, meaning accounts over 30 days late, any collections activities that are going on, or any bankruptcies that you may have going on. A tip here that I find useful is automating as many payments as possible improves my credit score in the long run. And I even let a few companies pull that payment out of my account themselves to make extra sure there aren't any mistakes. It's the oddball exception here or there that do the damage, and I find that the automation prevents those most of the time, albeit at the risk that the company could try to draw more than they're supposed to. Now, if you do miss a payment, it's going to stay on your credit report for 7 years, and it will significantly lower your credit score. Let's close the loop on my real-world example. The situation was that a previous mortgage company had reported that I hadn't made 2 payments on time several years prior. When I discovered this, I dug out the bank statements with the proof that I had in fact made those payments. I then filed a dispute through myfico.com and included those bank statements. And to my surprise, in just 3 days the corrections were made and my score skyrocketed. That's the significance of on-time payments in the credit score algorithm. Here's a general guideline for how payment history is judged. To be considered excellent, 100% of the payments on your credit report need to be on time. To be considered good, 98 to 99% need to be on time. The average is between 90 and 97%, and if you're less than 90% of your payments being made on time, you're considered below average. Again though, if you have a few late payments in your past, don't beat yourself up. Sometimes these things just happen, sometimes it's for silly reasons, and as we saw, it happened to me. But your past is not your future. Just make sure late payments are a rare exception from the past and you can fix it moving forward. Moving on to the next big component, amounts owed, also referred to as credit utilization. Now, there's actually a difference. Amount owed is the total amount of money you owe in dollars. But this component is actually more about the relative amounts you owe, which is referred to as credit utilization, and it's a percentage. Here's what I mean. Let's say you have $2,500 on a credit card. That's the amount owed in dollars. If that credit card has a $5,000 limit, you're using 50% of the available credit. But if that credit card has a $10,000 limit, you're only using 25% of your available credit for the same amount of actual money owed. For the credit score algorithm, a lower credit utilization ratio drives a higher credit score. The reason for this is that if you're using a lot of your available credit, a lender will consider this a sign that you may be overextended and at risk of not having enough money to pay your bills. If you think about this from the perspective of the lender, would you rather loan money to someone who is using only 10% of their available credit or someone who is using 90% of their available credit? The answer is obviously the 10% person, because your repayment won't be competing with other payments that they need to make, and also because the lender won't have to wonder why you're using so much of the available credit in the first place. So here are the guidelines so that you know what to shoot for regarding credit utilization. To be excellent, you'll want to be at 10% or less. To be considered good, be in the 11% to 30% range. Average is 31% to 60%, and below average is 61% or more. My tip number 1 for this component: if you're going to use credit cards, in general, don't let the credit utilization get above 20% before you pay it back down to 0. And try to keep the historical maximum below 30%. Now, I'm not perfect at this and my credit score is still quite good, so these are just good guidelines, not hard and fast rules. My tip number 2 here is paying attention to when you pay your credit card bill. I used to think that as long as I paid it off every month, the credit score gods would recognize me as their peer and would bestow a high credit score upon me. But this is actually completely wrong. Paying the card off each month is not how credit utilization is calculated. It doesn't seem fair, but that's the truth. And when I found this out, I was so displeased that I made an entire video explaining exactly how this works. I also explain exactly when you should pay your credit card off for maximum score boosting. That video is called The Very Best Day to Pay Off Your Credit Card, and I'll link it here and at the end of the video so you can watch it when you want to. For now, just know that paying the credit card down each time you have extra money available can potentially help. So tip number 2 is to pay the credit card down anytime you have some extra money. My tip number 3 here is to not close unused credit cards. Now, there are a couple reasons for this. From a credit utilization perspective, more available credit lowers the credit utilization ratio for any particular amount of money owed. Now, there are practical limits to this idea. If you have an absurd number of credit cards, say more than 5, it probably makes sense to get that number down to less than 5. You might take a short-term credit hit, but having a cleaner credit file overall for the future is probably the better choice. But if you do need to close some excess cards, keep the oldest card or 2 open for the credit component we'll talk about next, and that is length of credit history. Now, it's pretty simple here. A longer credit history is better for your credit score because it's just more data for the algorithms to look at, and it shows how you handle your bills when bad things happen. Here are the primary factors the algorithm uses for determining your length of credit history. The first is the age of your oldest account, and the second is the age of your newest account, and the third is the average age of all your accounts. Here are some guidelines so you know what to shoot for in this category. To be considered excellent, you'll need 25 years of credit history. To be considered good, you'll need only 8 to 24 years of credit history. The average is 3 to 7 years, and 0 to 2 years is below average. So if you're in your teens or if you have a teenager, getting them a low-limit credit card can really help. My parents were wonderful, supportive, loving parents, but awareness of credit history was something that just didn't exist in my house, and it would have helped me a lot starting out in my 20s if I'd had something other than 0 credit history. Here's an interesting fact. I was fascinated to find that the US is somewhat unique in this category. In other countries, your credit is presumed good until you damage it. But here, new credit, even if you have 0 problems, is considered not good. It doesn't seem fair. I don't think it's fair, and I don't agree with it personally. But it's the way the US credit scoring system works. So the tip here is to get a credit file started early in your life. The next component of credit score is called credit mix. This refers to the different types of credit accounts you have open. Examples are mortgage loans, auto loans, credit cards, retail accounts, and so on. Things like mortgages and car loans are called installment loans, meaning the loan amount is fixed up front and you make agreed upon payments called installments. Credit cards, however, are called revolving credit, meaning the amount can change every month, as can the required payment. It sort of revolves. Having a mixture of both installment and revolving credit increases your credit score, for the simple reason that it shows that you can manage multiple types of credit responsibly. Now, while credit mix is officially part of the score, it's important to not let priority inversion happen here. Meaning, don't take a loan on a car that you don't need to buy just to increase your credit mix. Instead, focus on the bigger contributors like payment history and credit utilization ratios, and let credit mixture happen somewhat naturally. Also, note that I have 0 auto loans, nor have I had any for years, so it's not even necessary for a great credit score. The final component of your credit score is new credit. This is important because it is a factor that will affect almost all of us, most likely a few times over the course of our lives. When we apply for a loan, whether a car loan or a mortgage loan and so on, the lender will perform what's called a hard inquiry. There are also soft inquiries, so here's how they're different and when they occur. Hard inquiry facts. These occur for a lending decision, typically mortgage applications, auto loan applications, credit card applications, and so on, but they can also occur during collection agency procedures. Hard inquiries do lower your credit score, and they stay on your credit report for 2 years. Now, here are some general notes about hard inquiries. These cannot be done without your authorization. If you're not sure if a lender is planning to run a soft or hard inquiry, be sure to ask them so you're very clear about what you're giving your consent to do. Now, also know that the credit score algorithms may treat several hard inquiries, if they occur in a short period of time, as a single inquiry. This is because they know that you may be shopping for a single mortgage or a single car loan, and that you're probably checking around for the best rates and terms. So the tip here is, to the extent that you can, group these inquiries as closely together as possible. The guideline to be treated as a single inquiry is about 2 weeks. If your applications are spread out over a longer period, these will all be treated as their own individual credit applications, and this will lower your score more. The second tip is to recall that hard inquiries don't roll off your credit report for 2 years, so be careful about how many you accumulate in that 2-year period. Now, here are some hard inquiry guideline numbers to shoot for. 0 hard inquiries in the last 2 years is considered excellent. 1 to 2 is considered good. 3 to 5 would be considered average, and 6 or more would be considered below average. Let's move on to soft inquiries. A soft inquiry is used for informational purposes. A soft inquiry does not lower your credit score, and soft inquiries typically occur when you check your own credit, or a lender checks your credit for pre-approval, or your credit is reviewed for screening purposes, perhaps by a leasing company, an employer, or an insurance company. A few extra tips about new credit inquiries from a friend who's a realtor and sees a lot of credit reports pulled. Every so often, my friend sees someone who's approved to buy a home, but between the loan approval for the mortgage and the actual closing on the house, the buyer decides to celebrate their new life by also financing a new car. What they don't know is that, just before the closing on their new house, the lender may well check their credit again. And that time, this new car loan shows up, and suddenly they're no longer approved for their mortgage. That new car ends up costing them their new home. So don't do that. The second credit-related disaster that my friend sees frequently goes like this. If you have any credit skeletons in your closet, or say you have any financial accounts that you've been keeping a secret from your spouse, new credit inquiries are when your spouse is going to find out about them. This is important because upon discovery of hidden accounts and unknown debt, the mortgage can be denied. But oftentimes, it's much worse. The spouse ends up filing for divorce, and those 2 lives fall apart entirely, all originating from a single credit application for a shared home, i.e. new credit. Now, I don't want this to happen to you, so tip number 2 is to clean those skeletons out before applying for any joint accounts with your partner. It's also important to know what information is not in your credit score, so that you don't have to worry about these things or worry that you're being treated unfairly. The first thing that's not included in a credit score is where you live, but this includes both current and previous addresses. So you may want that special zip code to impress your friends, but it's not going to be a part of your credit score. Next are your demographics and beliefs, age, race, religion, and so on. Lenders are prohibited by law from considering this information when making any lending decisions, or from using any credit scoring algorithm that does use that information. The next things that are not included are income and employment status. Now, there is nuance here. Lenders may consider these things when making decisions, but they're not part of the score itself. My next tip for improving your credit score is one that you've heard before, but it's to check your credit score regularly, or at least occasionally. Now, this isn't theory either. Occasionally checking my own credit is how I found out about that mortgage company problem that I had. I want to say thank you for watching this video. The amount of time and heart I put into them, quite frankly, I can't justify. But I want this channel to be successful so badly, well, it's probably irrational. If you're not a subscriber, I'd love to have you. Here's the video on the very best day to pay off your credit card.